Couple of points to note about the statement of cash flows. One item is that companies need to report significant non-cash activities. Either on the statement of cash flows or in the footnotes. What? You're saying the statement of cash flows is also going to report the non-cash activities? What are we talking about here? Well, let me clarify, and this should make a bit more sense. So a company can buy a building for $10 million cash, and then clearly we're going to see a cash outflow of $10 million in the investing section of the statement of cash flows. But then instead, the company takes out a $10 million loan and purchases the building. Very likely to happen. Take out that mortgage, you really don't pay anything. Let's say it's a no cash down mortgage on there. And so they just got that building with a loan. An investor doesn't see it on the statement of cash flows. Now, any good investor is going to look at the balance sheet and see a new building in the PP&E section up 10 million and a loan 10 million. We can do the math. It's obvious. But GAAP says that if it's something that could have been done in cash and wasn't done in cash, let's give investors that information on the statement of cash flows, because not everyone's as smart as we are. Look at the balance sheet. All right, so some examples. Buying equipment in exchange for a long-term note payable. Equipment, building, land. Long-term note payable. What other example? Converting debt, if it's significant enough. Converting debt into common stock. We have convertible securities. You can see that on the balance sheet, but we're going to give the investors some information at the bottom of the statement of cash flows or in the footnotes. And then also acquiring a building by entering into a lease agreement. I'm putting in building here. It could obviously be equipment or even land. It's just some specific examples. All right, so we enter into that lease. No cash was paid. Obviously, in our lease, eventually cash is going to be paid. But if we just see that where a company is entering into a lease agreement, but we do get that balance sheet onto the books, no cash has been exchanged, this is going to go onto the supplemental disclosures in the statement of cash flows. Statement of cash flows also has to report, always must report, the interest and taxes paid separately. Okay, so let's take a look at, here is Home Depot's financial statements. Let's take a look quickly at their statement of cash flows. All right, so we see our operating stuff looks a little bit different than what we talked about. We'll get to that. But we see net cash provided by operating activities, up $21 billion. Investing, the company is still investing. They spent almost $5 billion buying plant, property, equipment, and other businesses. And what about the financing section? They are using up cash in financing. Half of that was paying dividends and half of that was buying their stock, their own stock, treasury stock. We see the net change in cash, and we see cash beginning of the year. That gives us that total of cash at the end of the year. Supplemental disclosures, we see cash paid for income taxes, cash paid for interest, and non-cash capital expenditures. That's a nice way of saying what we said here, buying plant, property, and equipment in exchange for probably notes payable, perhaps a lease agreement. All right, one more note that we want to make before we continue on looking at how to get to that operating section and why it looks so different than what we wrote down. The next point that we want to note is that cash includes, you might see the term, the account, cash and equivalents. Used in place of cash. If we go back to statement of cash flows, I don't see anything here, but if I look at the balance sheet, I'm going to see a line of the account is cash and cash equivalents, this 3760. I should see on my statement of cash flows here, cash equivalents to end of the year, 3760. So what do we mean by the cash equivalents? We know what cash is. For the equivalents, we're talking about highly liquid. Remember, liquidity, easily convertible into cash. Very short-term maturities. And of course, we have a definition for what is that short-term, very short-term. The items mature within 3 months of the balance sheet date. More current than current. Okay, so highly liquid, very short term, maturity less than 3 months from the balance sheet, investments, very short term investments. So we would not include stocks here, even though stocks don't have a maturity date. But where we're talking about some examples, treasury bills with less than 3 month maturities, or if there's treasury bills that mature within 3 months after the balance sheet date, and money market funds. You have some excess cash, you know, if you put it into a checking account, you're going to earn very, very close to 0% interest rate. A money market fund is going to be very, very safe fund where the bank is actually investing your cash. You can go in and ask for that cash back. They are going to guarantee a certain return. It's going to be higher than the interest than your checking account would give, probably just a little bit higher because they're going to invest in extremely safe securities such as T-bills. These are not the only two examples, but they're probably the most common examples.